2026, we're here. We made it. Time to take off your pajama pants and get back to work.
Get back in the office.
Get back in the office. Nose to the grindstone. Let's go.
Let's go. Let's go.
What are we seeing for 2026, Gary? Give me some good news.
Well, I think there's a lot of optimism in the market, a lot of downward pressure. Not a lot. I'd say there's downward pressure from a rate perspective. Obviously, the government's doing their part and trying to get rates down, which is good. Data has been, it always is the wild card. So some months are good, some months are bad. Inflation seems to be kind of doing its thing in a, kind of easing perspective. You've got the big risk, I think, still is employment. We still have, I think, employment that will pressure rates down. You start getting those bad jobs numbers. We start seeing unemployment rising. You'll see rates get impacted that way. But yeah, we're seeing, last year. So perspective, last year, this year ago today, we were at 7, call it. Today we're at, 6 1/8, 6.25%. So 3/4 of a point better than a stick in the eye.
It's real money.
Real money. Yep, absolutely. 5s are definitely in the rate card on some deals. We're seeing, if you want to buy points and that sort of thing. But in general, things are good. Pipeline was good. I feel like we had a strong year as a company last year. I think this year we're seeing a lot more activity through that 2-week span of call it Christmas to New Year's post.
Yes.
So yeah, we're seeing some activity, which is good. Last year it was pretty quiet there for a few weeks, and then it kind of took off. And this year, I think you're just seeing more consumers are more apt to be in the market, whether it's in a refinance perspective or a purchase. So good activity.
And then what the press is kind of hooked onto this. The next 2008. Crash. I mean, we've been riding that kind of mini wave, if you will, for probably a quarter now. Yeah. Would you say we're seeing more of a softening than full-blown correction, or how would you advise people to look at those headlines?
I don't buy into the 2008 crash being similar to a potential crash in 2026, call it. Yep. The issue was back then was a couple things, but writing really, really bad loans to people that shouldn't have gotten loans fraudulently, even. Yep. That today, do some slip through the crack? Sure. But on scale, that was going on back then when they were lending 125% of the loan of the property value. That doesn't exist today.
No.
Where I think you would see some kind of a bubble would be if employment rates get up north of 5, and then you start seeing some foreclosures hit. But I don't buy this repeat of 2008. It will be a different phenomenon that impacts that or causes any kind of bubble to happen. And bubbles happen, right? Employment, recessions happen. Sometimes they're longer, sometimes they're shorter. But I mean, there's no real indication for a recession in 2026. I mean, GDP was screaming the last, Q3. So we'll see what Q4 turns out like. A lot of data to kind of bring in over the next 30 days to kind of see where we're going to be. The Fed won't meet until the end of this month, so they'll have a full lineup of data points to look at. And everybody's kind of, I would expect there to be just kind of a holding of rates to where they're at today.
Wait and see. Yep.
Yeah, I don't think there's going to be a rate cut at the end of the month. I think, which I don't think is necessarily a bad thing. Our rates, again, aren't tied directly to that. But I think, a January pause on the rates is not a bad thing. I think the economy's doing pretty well. The, big risk is employment. If we start seeing that pressure, then we need to start looking at rates.
Yeah, I think the 2008 comparison, I think you hit the nail on the head. It was a different world back then from a mortgage standpoint.
Yeah.
I mean, anybody could get a loan, and yes, the loan to values were absurd, and I mean it was a house of cards set up to fail as soon as the wind switched directions.
Yeah.
the rules of the game have changed dramatically. Whereas people, I should say people shouldn't be able to get into that scenario. Like you said, I'm sure there's some that slip through the cracks, but for the lenders that we work with, I mean, they're very vigilant in making sure that the qualifications are there and they don't have
100%.
they're not setting somebody up for failure. So we don't have that piece of the equation for 2008. Yes, the jobs things. Yes, there's some tech bubble kind of, artificial intelligence kind of bubble concerns, all that. It doesn't exist on the housing side because we've put in these protections. So I think, I mean, we're seeing corrections. I think you guys are still seeing appraisals come back lower than what they were a year ago. I mean, that's just the way the real estate market works.
I mean, and that's a good point. Like that's kind of like area specific. So, from where you sit in California versus us versus like, Knoxville, Tennessee, like those appraisals and values, it really depends. Like, I think what impacts us here in Parker County the most is that has been more inventory on the market for a longer period of time. And so there's not the comps that are out there are not like good for, getting a higher value, because a lot of people got to the point where they're like, hey, I just need this place sold. I'm either moving or I'm ready to, upgrade or downgrade. And they're willing to take a hit because they did take a bunch of equity over the last 3 or 4 years. And now they've got a little wiggle room. So I think that really just gets down to, your local market, really.
Yep. Yeah. All in all, I mean, the concerns from a customer level just seem to be, how much softening are we going to experience, and where will rates land? Right. Those are the two biggest questions. Should I do something now, or is there this cliff where rates are going to fall off of in July? And the answer to that is it's get in now and take advantage of the rates.
I'm not a big.
We've seen a lot of improvement even today.
It goes back to
so we're sitting in a
why
good
you
spot.
need to have a mortgage plan in place, and then
we're
from
always
there,
evaluating our lender network. And
you can make the
make
assessment
improvements and find different
of
ways to save
what the right
customers
deal
money.
is
So
for you, right?
That will continue through 2026. And we'll try
I think if you
make sure we're as competitive
you
as
sit
possible.
down, you get with your loan officer, any of our loan officers, they can help you kind of get to that place where you're in a position to make an educated decision and not be so tied to a rate number. Right.
I think look at the money piece.
Right. They'll have a plan, right? Like it just it's not like you're going and buying a a new outfit at the store. Like this is a big deal.
Yeah, big deal.
So
awesome. Well, good things to come. We're fired up. We are off to a good start in 2026 already. I think the pipeline's looking good. We're seeing, as you said, more activity over the holidays, which is obviously bleeding into to this week and this month. So, we're fired up. We're ready to go.
Absolutely.
We'll be back next week with another weekly update. We'll keep you updated on the latest and greatest in the news and the markets and any financial news that's coming out that might impact rates. And just a reminder to give us a like, give us a subscribe. And if you want us to run scenarios for you, get in touch with one of our loan officers. We'll be happy to let you know where you stand and where we think you might be in a month or so. Gary, thanks as always. We appreciate the time.
Yes, sir.
See you, everybody.